All right, good afternoon. Let's see, we got this going here. We got the mute is off, the radio is off. Good afternoon. My name is Mark Howard. I'm the programming chair at FIAZI, and it's my pleasure to welcome you to today's annual session with Bloomberg. We are really excited, but before we jump into today's event, I wanted to give a quick shout out to one upcoming FIAZI event that want to encourage you to put on your calendar if you don't already have it there. As I think everybody who's familiar with FIAZI knows, this is our 50th anniversary, and every event this year is extra special for that reason. But we're doing our spring sustainable finance capital markets event, again in conjunction with the Fordham Gabelli School of Business on April 9th. Many of you have attended this event in the past. It is our flagship sustainable finance event of the year, and we have a very robust collaboration both with the Gabelli School at Fordham as well as with MSCI to bring really smart, engaging content discussion. We also sponsor an academic competition for rising PhD students in the field of sustainable finance. And at this conference, we will announce the winner or winners of that sustainable finance paper competition. I've had the privilege of being one of the judges of these papers for the last several years. And I can say, without giving away any early secrets, that the submissions this year were by far the best ever. They were global in nature, and they were extremely thought-provoking across a range of topics. And so you'll want to hear about those papers as well. One of the keynotes this year is going to be the head of sustainability and geopolitics at Eurasia Group. And another keynote speaker will be Tansy Whalen, who runs the Sustainable Finance program at NYU Stern. So it's going to be a terrific event. Again, April 9th. Go to the FIAZI website for details about that, and hopefully you can join us. Now, on today's event is by far one of the most well-attended events of the year that FIAZI hosts, and we're thrilled to do it in conjunction with Bloomberg, one of our sustaining members, who's been a longstanding supporter of FIAZI, for which we're very appreciative. Joel Levington is the director of credit research for BI at Bloomberg. And as always, Joel has assembled an incredible team of experts across sectors and regions to talk today about some of their most important themes and investment ideas that they're researching for BI. And so without further ado, I want to thank Joel and team and pass the baton over to Joel.
All right, thank you so much, Mark, and thank you, Lauren. I was actually taking a look at our old PowerPoint decks for FIAZI, and they go all the way back to October 2015. So it's your 50th anniversary, and mazel tov on that. That's awesome. We're coming up on our 10th together, and it's been a great partnership, and I hope that continues for many years to come. And given that we're coming up on this partnership, I thought it would be good to give you guys a sneak peek at some of the new technologies that are coming out on the terminal before turning it over to my esteemed colleagues. So with that, Lauren, if maybe you can open up the slides. And it right? While we're waiting for the for the slides to open up, let me just highlight that BI over this 10-year period has tremendously grown. The team now, the broader team, is over 450 in size, and that is a global team. For us in credit, we have a team of about 40 individuals with 27 publishing senior analysts with an average experience of 18 years. Our team covers greater than 80% of the IG and high yield indices, with coverage fairly balanced, with about 50% in the US, 25% in Europe, and 25% in Asia. Let me just check with Lauren to see if she is able to open the slides. Lauren? All right, so maybe we'll work on that in maybe the next part if you're struggling with that. Let me turn it over first to Rob Schiffman. Rob is a great member of the team. He's one of the team leaders here. And Rob, you're going to handle the M&A panel. We can always come back to the slides and the new technology that we have if we are able to figure out the technology here. So with that, Rob, why don't I turn it over to you?
Awesome. Thank you, Joel. Everybody on the panel could pop on their video and audio, would be great. For those of you out there, I'm Rob Schiffman. I cover global technology, but today I am honored to moderate our best and brightest to discuss the M&A environment and its implications on credit quality as well as valuation. My esteemed colleagues will be joining. Arnold Kakuda, he covers banks and financials. How are you, Arnold? Matt Goitner, aerospace and defense and machinery, and a host of other industrials. Spencer Cutter, who is our go-to energy guy, and J.Y. Coopin, who follows primarily big healthcare, IG healthcare. Hope everybody is well and can hear. Listen, this environment, there's a lot of uncertainty out there, but big deals are happening. Just to name a couple, Mars, Kellanova, most recently Walgreens LBO, Google buying the Wiz. If you take a look at Bloomberg's MA function, which does a great job of summarizing M&A across sectors and goes into all the specifics that you need on any specific deals, it's highlighting about a 16% year-over-year increase in transactions. But here's the problem, right? There's a new administration, and that brings uncertainty. Tariffs, trades, deregulation, regulatory oversight. So what we're going to try to do is walk through a bunch of these issues, and we'll try to figure it out together. I do believe there's a Q&A chat room. So if you have questions while we're speaking, pop it in there, and we'll try to answer it. So why don't we just get started? So Arnold, to me, it appears that bank balance sheets are their strongest since 2008. So from a lending perspective, what's the outlook for M&A? And has this recent pickup in volatility impacted anticipated volume at all?
Yeah, thanks, Rob. So yeah, I think after the election, it was more everybody was I guess Jamie Dimon said bankers are dancing in the street. The risk on, everybody was very happy, and there seemed to be a lot of chatter about, oh, pipelines are full. This is going to be a phenomenal year for M&A. But with all these tariffs news coming out, and it seems like the party's rolling, but then you get that part in the movie where it's like, you get that screech in the record, and it's like things have stopped, right? So even though, yeah, it does seem like M&A announced seems to be up a little, but in terms of the deal counts, right? I think it's kind of skewed towards that huge, some of these big deals that were announced, Google Wiz, what is it, 30 billion, right, in your sector. But, there seems to be a lot of pause right now. But what we're still hearing from, the CFOs, CEOs of the investment banks are that, hey, pipelines are still full. This is just like a bit of a temporary pause. So maybe, once some of this news flow passes through in terms of, tariffs, once we get more clarity on that, then we'll start seeing more of this activity pick up even more.
Yeah, so banks are not the limiting factor here, is what you're saying. There's plenty of money to be lent if somebody needs it.
Absolutely, yeah, and I think a good example, the Mars, Kellanova deal that you talked about, huge deal. I think record demand, right, for like a 30 billion plus 30 billion-ish LBO type, right, and I think it just goes to show, even despite this volatility, money wants to get put to work, right, and a lot of people are expecting this stuff to happen. So on the days that we don't see there isn't kind of volatile news. And I think, the markets, the financing markets are very active, these days, because, hey, you never know what you're going to get on April 2nd, right? When we get the next series of potential reciprocal tariff activity. And even today at 4 o'clock, right, I guess, stuff in the auto sector might be coming out. So.
Yeah, yeah, sure. Well, why don't we start by just walking through a couple of the sectors and seeing what the outlooks are. So for Matt, you cover a broad swath of industrials. There's been just an unlimited amount of rhetoric coming out of the White House, and it's hard for everybody to interpret. Has that been putting a damper on deal activities, or do you see in the first quarter somewhat of a pipeline starting to build?
Surprisingly not. We've actually seen a pretty healthy pickup in terms of North American M&A volumes, at least this far into the first quarter for industrials, which after accounting for the Cintas UniFirst deal, which was valued a little over $5 billion, falling apart a couple days ago, volumes for the broader sector of deals are actually, whether they're proposed, pending, or already completed, totals about $75 billion so far. And that's a multiple of last year's total for the quarter, which stood about $35 billion. So you've got guys like Boeing, who's actively shopping its Jeppesen unit, Emerson, which announced they'd acquire the remaining shares outstanding in Aspen Tech that they didn't already own. So that ended up valuing the minority stake for them at a little over $7 billion. And then rounding out the top three largest deals within the space, for which we've got data using the M&A function, as you highlighted at the top of the call. Herc decided to up the ante by beating out URI's bid for their equipment rental peer H&E Equipment at the end of the go shop period that began in January after URI's initial salvo. So those three deals account for about $20 billion alone, and about a quarter of the total volumes in the space. So we're not short of opportunities.
Okay, we'll come back to you and talk a little bit about what the implications are for those that you're covering. But one of the biggest spaces where we're seeing M&A activity has been energy. It's second only to technology. And, the real difference between technology and everybody else is a lot of my tech companies, they just write the checks themselves. So if it's Microsoft, buying Activision for 70 billion, they just write the check. Or if it's Google buying the Wiz for 30 odd billion, they just write the check. But others can't do that. So Spencer, why has there been so much activity in the energy space? What are those factors that are driving? I think what's over $500 billion of deals that have been announced over the past 2 years.
Yeah, there's, in my view, there's really three primary factors that have been driving the M&A activity. And I don't know that I don't expect any of them to be directly impacted by any new policies from the Trump administration. But the factors I've seen are: one, the desire to strengthen what were over-levered and somewhat damaged balance sheets after the 2020 downturn. Two, to boost synergies and cut production costs, which applies to pretty much every industry out there. But then also try to access top-tier reserves. To kind of go through those really quickly, each one, if you kind of go back to when the North American U.S. fracking boom started in 2005, it was really kind of the Wild West. And the primary focus was expanding production and expanding your footprint, not so much expanding profitability. And that's a very capital intensive process. And most of that capital came in the form of debt. And fast forward to 2020, you had two downturns, two big waves of bankruptcies, and investors and producers kind of figured maybe having a lot of debt on a industry that is so directly exposed to a cyclical commodity is not the best idea. So there was a focus on delevering. And you could do that using free cash flow to pay down debt, use asset sales to pay down debt, or what you saw a lot of going on in the industry was use equity to buy other companies and expand your asset base without really incurring a lot of new debt in the process. Also, the North American fracking business model is very different from the old-fashioned exploration and production model. You don't have wildcatters going out there spending money on a hunch to try to drill a well on a field over there, or there's not as much of the big companies spending billions of dollars on geological research, trying to figure out where oil might be, and then spend a few billion dollars drilling some exploratory wells, hoping that it pays off. If you think about where we're fracking in North America these days, most of the basins are regions where we had already drilled decades ago, if not even centuries ago in some cases. So we knew where the oil and gas was. We just didn't know how to get it out of the ground. Fracking changed that model. And now we know how to get it out of the ground. It looks a lot more like your sort of old-fashioned factory assembly line production model rather than an exploration one. And in that kind of situation, low-cost provider wins. So companies are looking to expand their economies of scale, find synergies, cut costs. And then finally, and this is really coming to the fore more recently, you're starting to hear a lot of talk in the industry about tier 1, tier 2, and tier 3 reserves. Tier 1 being the best, most productive areas to drill, tier 3 being less so down the ladder. A lot of people in industry are starting to sound the alarm that we may be running out of tier 1 drilling opportunities in the next 5 to 10 years. Conference a couple of weeks ago, CEO of Occidental Petroleum said they think U.S. peak oil production may be hit somewhere between 2027 and 2030. And Scott Sheffield, who founded Pioneer Natural Resources, said that he thinks we may run out of good drilling locations by 2035. And in fact, the lack of additional tier 1 drilling inventory was one of the reasons behind his decision to sell the company to ExxonMobil in late 23. So companies are pursuing mergers for all these reasons, but also to just expand their runway into top tier drilling locations. So with that as the backdrop, I'd expect activity to continue for those reasons well through this year and potentially in the next as well.
Wow, so a lot more deals. Let's move over to healthcare, where probably the outside of tech, I think that we've seen the most innovation over the last few years, and much of has been positive, but also really negative as companies have been attempting to constantly cut costs and innovate. JY, why has healthcare been such a hotbed for M&A, and what are we expecting to see in terms of acquisitions later this year?
Yeah, well, I would say historically, healthcare has been a hotbed of M&A. We're seeing so far this year, up to the beginning of March, about 60+ billion of acquisitions, fairly concentrated, about the top 10 representing 40 billion out of 60, which is up about 14% year to date. And I think the main reason why we are seeing this activity, and we should probably see more towards maybe in the second half of the year, is that it's still fragmented sector, especially for medical devices. We're still seeing companies that are for sale. For instance, the recent acquisition of Solventum's filtration business by Thermo Fisher for just over $4 billion. That's a small bolt-on deal for Thermo, but it shows that there's always some opportunities to do more. Going forward, I think we should see two different types of deals. Smaller bolt-on acquisitions, deals that do not have any or much impact from a credit standpoint for the acquirer, fairly easy to digest, and potentially, some larger transactions. The transforming acquisitions that we've seen, for instance, the 20 billion acquisition of PPD by Thermo Fisher back in 2021, those could potentially have a negative impact for this company, for their credit ratings. I think in the near term, especially given what's going on with tariff and the uncertainty in terms of tax bills and what could be the cost of operating the business going forward, I think we will probably see limited number of transactions. But because of this potential for further consolidation of medical devices, I think we should see more transactions. Now, moving on to pharma, I think pharma also falls into that category of sort of wait and see for now. But I think the main driver for large pharma companies is patent expirations. And going forward, some companies, including Pfizer, but also Merck and Bristol Myers, are facing with over the past 5 years, billions of dollars of revenue that could come off patent. And so that is likely to drive the need for M&A, as it takes a long time to bring a new drug to the market. They might actually go out and buy companies with existing drug in like sort of late phases of trial going forward.
Okay, good. Well, why don't we start digging a little bit deeper into some more specifics. Just from a little commercial perspective, our BI credit analysts are covering about 600 companies right now, with anticipation of getting that probably over 1,000 through a combination of additional hires and the beauty of AI. You're going to see a little bit from Joel in just a few minutes with a CRAN function about the power of comparability that we have. But Arnold, what you did, you've done a couple of these. You've been the lead author of a few team M&A notes, talking about the real impact that they're having on valuations, in particular within a credit market where spreads are at or near historical tights. So where from the big picture has credit been seeing the largest risks, and is there a way to avoid some of those risks?
Yeah, absolutely. So, just to plug our what we're doing at BI a little bit more. Yeah, we have great functions coming out, like you mentioned, CRAN, but also the way we do our primers, right? We kind of assign a lot of favorable, unfavorable, kind of neutral to a lot of different metrics, right? And we're putting more and more of this stuff onto the terminal and more sortable. So if we do go into the dashboard, you can see, I wish we had a slide on this, but you could basically sort in terms of, out of the 600 companies that BI Credit covers, all right, let's look at where, the valuation is unfavorable, and then also look at where, the analysts have designated M&A as a risk, right? And so you kind of combine those two factors together, and what we have is, what comes out at the top is, we have a company, the analysts looking at Simmons as well as Danaher, which I guess is Joel or Matt. Those are some of the companies that were these two things, where the unfavorable valuation and then the M&A risk do come together, right? So at this point, that's where it seems like the risk lies. But on the flip side, I'm going to kind of go back to what Spencer said during his segment, where the thing that's a little bit different now, in terms of, we call it, we're talking about M&A here for corporate bonds, but the risk is somewhat mitigated by the expensiveness of debt, right? So since 2022, 2023, we've had this massive rate rise, inflation, right? And that's made in terms of M&A, you can finance that with like Rob's company's cash on hand. But if you're not that fortunate, then you'll need to borrow or issue equity, right? And then in terms of that equity and debt mix, right? Equity valuations, even though we've had some volatility over the past few weeks, you look at the valuations in equity, and that's still pretty expensive, right? And then so there's a metric that we look at. We look at the corporate bond yields, right? And that's really gone up a lot. And then we look at the inverse of it's called the earnings yield on S&P, which is everybody's familiar with the PE multiple, right? For stocks, you take the inverse of that, the earnings over price, and that's the earnings yield. And typically those two things, the earnings yield on stocks as well as the corporate bond yields, they track well together. But we've seen a disconnect, right, since the rate rise in 2022. So what that basically means is debt is more expensive now, obviously, because rates are higher and we have some inflation, and so that's steered some companies to increasing the equity mix, right, on in terms of how they finance M&A.
Gotcha. And listen, just from my 2 cents, some sectors are going to be different, right? That tech, they're almost blocked from doing the vast majority of deals. The government just doesn't want big tech to get any bigger, and that's why you're seeing a lot more money being poured either back to buybacks or now the latest craze is just putting money into capex and AI data centers. But I do think that. Go ahead, Spence.
Hey, I just wanted to follow up on something Arnold said, because it strikes me that the trend in the energy space might actually move in the opposite direction in terms of more debt versus equity. As I mentioned, a lot of the M&A deals that were done recently were, if you have two public companies, so public company A buying public company B, 99% of them that have been done since 2020 were 100% equity funded, and they're, as I mentioned, all trying to strengthen their balance sheets. The only time you had a significant portion of cash involved was if it was a private company's seller. So they want cash instead of stock to be able to return to their LPs. If you look at what happened, what's happened to the stock prices, though, however, since then, even though these companies are hyper focused on using free cash flow to pay dividends and buy back stock, the oil and gas exploration and production shares lost 3% in 2024. That underperformed a minor 2% gain on the S&P 500 energy index and the massive 23% gain on the S&P 500. So I wouldn't be surprised with energy stocks performing so poorly relative to what's going on in that industry and the amount of free cash flow they're producing and the amount of stock that they've been buying back, that if they don't start shifting their focus on future deals to say, you know what, maybe I don't want to issue as many shares to fund this acquisition. Maybe I'll actually do 50% debt versus 100% equity. So we'll see where that goes. But I got to feel like these companies are really looking for a way to boost their shareholder returns. And so far, nothing's been working.
Well, let's think about a specific deal where the amount of equity is pretty small. It's Walgreens, right? They're being LBO'd, and maybe that's not such a surprise after we've seen their valuation get somewhat annihilated over the last couple of years. But JY, what are some of the lessons that bondholders are relearning after a period of not seeing transactions that are so heavily debt financed? What do we think that bondholders have learned from seeing such a large leverage deal?
Well, paradoxically, what bondholders are seeing is that the bonds are trading higher now than they were before the LBO was announced. Exactly, for now. But yeah, I think that's, the main reason for that is that those bonds, especially the long-dated bonds, have a change of control clause at 101. So that, in theory, could offer some protection to bondholders. Now, I think, the predominant view in the market is that the change of control clause will be exercised, and then bondholders will be protected from, a significant increase in leverage. The view that I've been, writing about and exploring is, as always, the devil is in the details. I'm not talking about, Sycamore challenging the wording of the change of control, as it may, probably some ways to do that, but I'm just more trying to think in terms of structure. And is there a way, this is an LBO, it's $12 billion valuation, 20 billion of debt with existing debt. So it's a lot of debt. The company has been suffering from a deterioration in free cash flow. So I think saving cash is absolutely paramount for the new private equity owner to be. So one way maybe that Sycamore could do is not to trigger the change of control. And by not triggering the change of control, I mean trying to avoid a downgrade, especially for the long-dated bonds. And I think it really boils down to structure. Walgreens has 3 different businesses. I think what Sycamore is seeing in terms of value that maybe some people were not seeing before is that they could probably sell the different businesses, the 3 businesses, Boots in the UK, the medical business, and Walgreens in the US, and unlock some value. The end game being clearly to try to return cash to private equity owner. And my argument is that by providing security to those bonds, if you look at the bonds being pushed down at the Walgreens US business, if you conceivably you could probably increase leverage to the sort of 5.5, 6.5 times, but which will be like a full turn compared to where Boots as a group is current leverage stands, and therefore the idea is by giving those bonds which are currently unsecured some guarantees, you may be able, and I say may be able to maybe offset some of the pressure and leave those bonds outstanding, which will save on expenses for the group. So I think it's probably a narrow path there. But I think there may be a view, and I wouldn't be surprised if Sycamore is actively looking to try to avoid triggering this chain of control.
Gotcha. It sounds like lesson learned here is, for a long time, covenants don't matter until they do, and actually being able to dig deep, figure out what they are, what they mean, and the implications. That's what BI analysts are here for. So make sure that if there's a name in the news, you call your BI analyst. Let's wrap up this panel with one more question. Cannot talk to Matt Goytner without having a quick conversation about Boeing. Matt has been all over this, on top of this story, and has nailed it from day one. Boeing now, it appears as if in order to raise liquidity, increase financial flexibility, they are a seller of assets. So Matt, where do they stand in terms of monetizing certain assets, and what does that mean for credit quality and value?
Yeah, so the Boeing's, they've got a few businesses they're looking at jettisoning over the next year. Two of them are further along the line, and the one that's closest is probably going to be the Jeppesen unit, which is the navigation and flight planning unit they have, which is omnipresent in all cockpits around the world. So that would only improve what's a pretty solid cash position at this point after they had successfully raised 24 billion in the fall from a combination of equity and a mandatory convert. So they've got balance sheet cash to endure what may end up being about $6 billion worth of cash burn here in the first half of the year before needing to inflect positive in the back half. So that could leave them with north of somewhere around 20 billion in cash in the balance sheet, sans any proceeds from the Jeppesen sale, which could come in around 7 billion. And I'd also note there's reports that Citi and Apollo are actually offering to fund the deal as part of their private credit partnership. So with the recent NGAD win and deliveries that look like they're taking form, I think that they're on a path to improve their financial risk profile in line with levels that would be necessary to sort of move off negative outlook at Fitch and Moody's and cure the review for downgraded S&P, and would offer them a lot of financial flexibility to pay down what's a pretty significant maturity spire next February, totaling about 7 billion. So that would keep them above the minimum liquidity need that they have, which is around 10 to 12 billion in cash on the balance sheet.
Awesome. Well, listen, the good and bad about BI analysts is that we could talk forever. In this case, it's bad. But normally it's pretty good. So if you ever need anything from this team, feel free to reach out directly to Arnold, Matt, Spencer, JY. Thanks so much. At this point, though, I'm going to turn it back to the boss, Joel, and he's going to go over some super high level terminal functionality. Thank you, everybody.
All right, thanks, Rob, and great job, team. It looks like we have the ability to get the slides back up. And here are some of the technologies that are coming online, some as quick as next week that we're very excited about. So Lauren, if you can click the slide. There we go. We have a function out. This is going to be the first BI credit function ever, which is exciting. It's also the first new credit function on the terminal in 12 years. It is called CRAN, so hopefully we can market it with a lot of vodka and have vodka CRAN together. It is really 4 tabs. In this first tab, what you'll see is that we'll have real-time credit medians that'll be out. These are global, and you'll be able to compare to whatever ticker you want. We have Disney in here, and you'll be able to see very quickly whether it's profitability, cash flow and leverage, liquidity, what the company stands at relative to its ratings. You can see in this quick shot on the bottom table, very easy to see with reds and greens that Disney is not looking all that great. You can see on the chart on the right how it looks relative to its peers. And then the broader picture shows you like the A tier, and here's where, this is for operating margins, here's where the full A tier stands, as well as the peers and Disney. So that gives you a lot of quick information on where Disney is now. Lauren, if we go to the next slide. One of the things our team has done is gone through the top 1,000 or so issuers and created peer sets. So in this case, Steve Flynn has looked at Disney. He looks at Fox, Comcast, and Netflix as the peers. And then you get this heat map, which shows you right away, like where things stand. And again, relative to some of the peers that are rated below Disney, it doesn't look all that great. But we have given you the value of the peer set and that heat map as well. If we say like, well, what is it, where are things going? If we go to the next slide, that will answer the question. What we've done is we've leveraged the data in MODL to say like, what will things look like at year end? And calculated it pretty close to the way the raters do and giving you this other insight. So clearly what it's signaling is the upgrade trend at Netflix may continue, whereas Disney doesn't really show any upside, but still has the potential risk of some downside risk there. So from a fundamental basis, we've given you, here's what it looks like. If we go to the next slide, here we go. We can look at default risk, and this is using the DRSK tool on the terminal. There's another default data set that we have too called MIPD, and you'll be able to use that as well. Really, I guess there are 2 things here that I would point out. One, in the red arrow, it shows where Disney is and how that compares to the broader range of peers that it has. This would be the high grade TMT space. what I find is that clients are much more interested in the upper right side. So who's the risk outlier within the peer group? In this case, it's Vodafone. Amazingly, our team covers a lot of companies, including Vodafone, and can give you the why that is, which is also important. But one of the things that we did with CRAN is that we made it very flexible. So while we have our data set in there, if you want to put in your Launchpad, if you want to put in a worksheet, if you want to put in a SRCH or a EQS, like different searches, if you want to put in the S&P 500 as an index or the Bloomberg Barclays index, like you can do all of that. If you want to use your portfolio from Port, you can import that into CRAN too. So it actually becomes kind of more like a template, not just a function, where you'll be able to put that in and see what default risk looks like for your own coverage or for your own portfolio. And then on the last page, if we go to the next slide, we have a built-in relative value tool. And the nice thing about this is because our analysts have put in peer comps already, you'll be able to have this done automatically. So you don't really have to go through 100 different clicks to put in your peer sets. Obviously, if you have some names that you'd like to add or specific bonds, you can. In this case, the blue curve is the Disney curve, the green is the peers. So despite the fundamentals not looking great, Disney trades very tight to that, which is one of the reasons why Steve has a red on valuation. Obviously, we can't say buy, sell, or hold, but we can use red, yellow, and green, and hope you guys understand that. So that tool will be out on Monday. If anybody has any questions about the tool or how to use it, you can reach out to me. You can reach out to anybody on the team. It works whether it is a non-financial, if it's a bank, if it's a real estate. It'll turn, the metrics will turn to those metrics that our team thought was most valuable for everybody. Two other quick things. If we go to the next slide, I think this is going to talk to what Arnold was trying to talk to. On our credit dashboard, which is BI Cred Go, we do have this idea generator where you can see, like, if you're an analyst and you might want to use the sort on the left side, which is just looking at autos and relative valuation, if you're just looking for ideas. And if you want to know the why, like why Ferrari is green or why Volvo car is red, you just click into the little research button. That'll take you right into our analysis, and hopefully that will give you the why. If you are looking from a PM standpoint, on the right side, we have the same kind of analysis, but really looking just at the single B group. But if you wanted to say, give me single Bs that are domiciled in the US, that also have green earnings, like you'd be able to do these sorts. So these tools are on the terminal today. And can be used. What is exciting is last week they were put into BQL, and so they can be used as regular API pulls. So if you're making charts on the terminal or if you're doing sorts, soon enough it'll be in FIW and SRCH. So if you want to do a FIW relative value chart, but color the bonds by the color of BI's valuation, that will be something for the future that you'll be able to do. And then on the last data set, if we just go one more slide. Yes, we have adjusted leverage metrics, and I would say one of the feedbacks that we get here is, can you guys produce metrics that are more consistent with how raters think? And this is our response to that. This is being rolled out as we speak. All non-financial teams will have this on their dashboards as well as on BI Cred, where you'll be able to see all the adjustments that are made, whether it's OPEBs or underfunded pensions or operating leases or equity credit for hybrids. Those adjustments have been made, and you'll be able to peer it as to like what the reported number looks like in contrast to what the adjusted metric looks like. Once that is out, and hopefully that'll be out by the middle of the year, that'll also be in BQL form and easily usable in any of your Excel sheets. So we're happy to be able to bring these new data sets and functions. And again, if anybody has questions, feel free to turn to me or any other member of the team. We can answer questions about them. So, so with that, let me turn it to Steve, who is going to cover the next panel on the consumer. Steve.
Sorry. Hello? Can you hear me now?
There we go.
All right. Sorry about that.
Hi, Steve.
Off to a smooth start. My name is Steve Flynn. I'm a communications analyst for Bloomberg Intelligence, team leader for the U.S. business along with Rob, and I'm very happy to be moderating the State of the Consumer panel. It's been quite a few years since we've seen this much uncertainty regarding consumer confidence, and I don't know if we've ever seen as much uncertainty with regard to tariffs. It's a very difficult environment for investors in the consumer cyclical and non-cyclical sectors, but we have a great panel of BI senior credit analysts to provide insights into the state of the U.S. consumer, including some bright spots, I've been told, and some interesting M&A activity. Joining me in the panel are Jody Laurie, who's our senior credit analyst covering leisure, lodging, and restaurants. Julie Hung, who's our senior credit analyst covering food and beverage and tobacco. And Mike Camplone, who's our senior credit analyst covering retail and supermarkets. So I'm going to kick it off with questions on tariffs, which definitely seems to be the big news item today, yesterday, and probably tomorrow. So Mike, there's no shortage of tariff news out there. What's the impact for the retail sector?
Yeah, you're absolutely right, Steve. And I think it's important to do a look back. The last time we had a significant tariff impact back in 2018, 2019 with the China import tariffs, where retailers were really able to mitigate the impact by passing most of their rising costs on to U.S. consumers, with inflation much lower and trending at about 2% around then. So though retailers have diversified their supply chains and improved inventory management since then, this tariff cycle is occurring amid already elevated prices following high inflation in 2021 and 2022. So concern over the impact to consumer demand is really evident across all of investment grade and high yield retailers, from Costco and Foot Locker, anticipating consumers are going to turn more selective and lead to a pullback in consumer spending. Others, including Target and Carter's, have really cited that they have more diverse supply chains and are able to blunt any of that tariff fallout. Actually, Target recently shared that around half of what it sells is made in the US, and related to its own private label brand production, it's reduced sourcing from China from roughly 60% back in 2017 to around 30% today, and aims for less than 25% by the end of next year. So definitely some significant progress there around improvement around the supply chain. Speaking more broadly, the apparel sector is one subsector where risk is probably more elevated from our perspective. Demand is already weak, and China is the largest exporter of apparel and textile products. So this really increases the risk for companies who haven't made those moves to diversify their supply chains since the 2018-2019 cycle. So that's really where we're focusing our attention and risk.
All right, great. Thanks, Mike. So Julie, switching over to food, beverage, and consumer products, how are the tariffs impacting your companies?
For the food and beverage companies, it's mostly a wait and see. And that was the message that we got when we went to CAGNY, which is the annual consumer conference out in Florida this year. We were expecting a lot more discussion on that, but it was a lot of, we're unsure, but we're well prepared. So companies have said that they've been shifting production and raw material sourcing to other countries. Some have said they've worked with past administrations, so they can adapt pretty easily. Molson Coors, for example, produces in Canada for Canadian customers, and JBS this morning said they can mitigate any risks given how global their operations are. Constellation has about 85% of sales tied to Mexican beer. They have some room to raise prices, but in the last administration, they got an exception. So we're waiting to see if they get another one this time. Newell Brands is probably our most exposed name in the coverage. They have some writing products in Mexico, but they're looking to shift to a facility in Tennessee. Graco car seats are manufactured in China, but they're applying for an exception. And they've said for the past few years, they've been working on reducing dependence on China for sourcing, and they're on track to reduce imports from China to less than 10% by the end of 2025. And last week, the CEO was interviewed by Bloomberg TV, and he said that they are well positioned to respond.
All right, great. Thank you. So Jody, switching over to your sectors, I don't know if tariffs really impact leisure, lodging, restaurants directly, maybe restaurants, but definitely increases or has an impact on consumer confidence. So what are your companies doing in this uncertain macro environment?
Sure, Steve. Yeah, I mean, what we've discussed is that a lot of our companies aren't directly affected by tariffs. It's more how tariffs are going to trickle into the psyche of the consumer. And it depends on where you look within my space. There's certain companies within my space that, the cruise lines, for example, that have a nice little cushion when it comes to bookings. And for them, they are, they have this tail so that they're not as much exposed to consumers' pullback. Now, that said, if consumers are spending less, even if they do go on vacation, such as a cruise, they might not splurge on the additional items where the companies get a lot of their margin, get a lot of their additional cash flow. And that's where you can kind of see a pullback. Restaurants are sort of the other side of the equation in some sense, because they are actually in a situation where, yeah, they depend on food and beverage, they depend on supplies such as restaurant equipment. Darden commented that they have the ability to absorb it. They were more focused on the inflation component related to tariffs than the actual sourcing. But if you talk about some other companies in the space, such as companies that are dependent on avocados or products that we might source from key tariff areas, then you do raise the question of what's that going to mean for the companies within my space. By and large, it's more of an appearance and how consumers sort of then feel it in their wallet, and how they're going to then go and look at both the summer season as well as beyond that into 26 for spending, and how businesses are going to do the same, because we haven't gotten business travel back to where it once was.
All right, great, thanks. So piggybacking on your comments regarding the health of the consumer, Mike Campbell, how's that impacted the health of the consumer with regard to the retail sector and spending habits?
Yeah, it's interesting because company commentary around the health of the U.S. consumer, at least from the retailers, is one element of this conflicting economic soft and hard data narrative that's been widely discussed out there. The hard data still indicates a healthy labor market with hiring continuing, and that's really kept wage growth strong. And as inflation has kind of fallen back a little, has translated into real wage growth. But the soft data, including on U.S. consumer confidence, shows declining sentiment amid concerns about higher prices. So we saw data from the Conference Board out this week showing inflation expectations over the coming year increasing to the highest level in 2 years, and respondents saying that their expectations for future finances declined to the lowest level since July 2022. So absolutely a sentiment shift from the macroeconomic standpoint. But going back to individual retailer company commentary, Walmart's made comments at the end of February during its earnings call that U.S. customers remain resilient with behaviors that have been consistent over the past year, looking for value, upper income households continuing to account for a majority of the share gains at Walmart, where company commentary from a department store, Macy's, at the start of the month said the health of the consumer remains very similar to what was observed in the latter part of 2024. So a consumer that's under pressure, navigating higher food prices and housing costs, but still wanting to indulge. And, even going back to Target, commentary around the consumer included a willingness to still splurge on products that were new, despite overall cautious approach to spending, especially around discretionary categories. So definitely a wide range of responses from retailers and commentary from retailers, and then that conflicting economic data narrative also playing a role.
All right, great, thanks. You made some interesting comments about inflation impacting, consumer confidence. Julie, how has inflation impacted your sector? I imagine it's pretty big with regard to food and beverage.
Yeah, food inflation is still a headwind. Food costs are still elevated, and we continue to see consumers stretch their budgets at the grocery stores. So, piggybacking off Mike's comments about, there is this bifurcation of spending, and Mike, Jody, and I have written and commented on this, a number of times in some of the reports that we've written that you can find on the Bloomberg terminal. But the consumer, and as we've heard from a lot of these companies during earnings calls, is that they are still stretched. They're still, prioritizing how they're spending their money, and even at the grocery store, I mean, you hear General Mills and Campbell reporting weaker snacking. So Again, even within grocery stores, consumers are spending on essentials, and snacking is considered a discretionary purchase. And now with the potential tariffs, kind of just floating through the entire consumer sector, this can elevate input costs more, which will eventually be passed on to the consumer. We've also been hearing like food at home trends are going strong. Cooking at home is 4 times cheaper than eating out. So again, that's another signal that food inflation is on everyone's minds.
All right, great, thank you. So when I introduced this panel, I said we had some great panel experts here and that there would be some bright spots. Jody, in your notes to me, you said there were some bright spots in leisure. We'd love to hear them.
Sure. So the bright spots in leisure, it really, first of all, it depends on the company and it depends on the sector. So I think, Julie's talking about food at home and people are feeling stretched and the consumer wants to pull back and they're buying on essentials. They're not spending on snacking. But I think something that the consumer also has been conditioned to do is since COVID, they're realizing that experiences are more important. And we're seeing that time and again that leisure is sort of proving out in terms of where people are spending their money, but that's not equally rated across leisure. So if you take casinos, for example, a company like Wynn might do a little bit better than a company like Caesars from the standpoint of what type of consumer goes to Wynn, the higher end consumer versus Caesars. Similarly, a Marriott might do better than a Choice hotel because the low income consumer sort of gravitates to Choice. And I would argue that while a consumer might quote unquote trade down to another brand of hotel, or they might try an alternative such as Airbnb or Vrbo, at the end of the day, I don't think the Marriott core consumer is going to trade down to a Choice brand. And in fact, Marriott is channeling that by entering into these extended stay and middle market to lower income areas to offer their clients more of an option should their wallets be a little bit tighter. But I think, going back to the cruise lines, I think there's still a little bit of cushion there. And even from a standpoint of when you're thinking about it from the debt perspective, Carnival was just upgraded to one notch up below investment grade yesterday by S&P. And so these are companies that really were on the brink in COVID. They were not allowed to operate, and they've come back very, very strong. And so far, their bookings trends are so promising. Whereas you compare that to theme parks, they've had a rough go for a few years. They were early in getting the benefits of post-COVID spending, but since then, a lot of consumers have pulled back. And as we talked about with our survey results, we do a survey every half year on US travel. And if you look at the survey participants who plan on going to theme parks for their vacation this year, the average income is below that of the average US consumer. And by and large, what that means is the low income consumer, the ones that we talk about as being stretched thins, the ones that we talk about as borrowing, as having challenges, those are the ones that are going to theme parks. And Steve, I mean, you could chime in on that with Disney also. You and I like to trade notes on that with my companies and theme parks, and then of course Disney as the theme park company, and then Comcast.
Yeah, no, so Disney has talked about lower customer spending at some of their theme parks than they expected in the start of this year. And then you also have the competition because Comcast is opening, or Universal is opening some very large Epic theme park this year down in Orlando, so there'll be more competition. So we hit inflation, we hit consumer behavior, some concerns there. Mike, what does this all mean with regard to retailers that are at most risk of deterioration in their credit metrics?
Yeah, so I think the biggest thing to note is, higher tariff exposure does not necessarily equate to higher credit risk or downgrade risk, and that the impact to retailer credit metrics and potential downgrade risk will really depend upon a company's ability to mitigate higher costs, what their pricing power is, and their existing balance sheet cushion relative to credit rate or downgrade triggers. So some of the names that we've been pointing to have been retailers that have already been managing pressured credit metrics, and these include retailers like Kohl's, Dollar General, and Under Armour, and we don't really see those trends reversing over the near term.
Great, thanks. And I know Rob had the M&A panel, but Julie, you have a big deal on Mars Calanova. Do you expect any other deals near that size this year?
There's about $51 billion of consumer debt capacity for acquisitions, and that's at least $51 billion. Not all of it will be used, but we are seeing companies branch into healthier options and buying smaller companies rather than growing organically. So M&A for them is a good way to expand their portfolio. And with the trends in GLP-1, higher protein, higher fiber, lower sugar, that was a big topic at CAGNY this year. It's faster for companies to buy into these healthier companies to bring into this than build on their own, since it would take a long time to get scale. Now, the Mars Calanova deal, that was $36 billion, $26 billion of bonds in 8 parts to finance the deal. It's very large. I mean, we believe the focus will be on tuck-ins, and similar to what JY was saying in the healthcare sector, mostly $500 million or less. Much fewer, very, very limited large-scale deals like Mars Calanova, and even again going back to JY's Walgreens Boots LBO, those are more the exception than the trend. Companies are focused on maintaining healthy balance sheets and net leverage targets, so you're probably not going to see most of the deals levering up, having the companies lever up so much to complete them. PepsiCo recently announced 1.7 for Poppi, which is a prebiotic soda brand, and Siete Foods, which is 1.2 for $1.2 billion. Any largest deal will probably be in this area, but generally, I think we're going to see the $500 million or less. And the Bloomberg terminal, going back to Rob's reference, MA Go will help you see like deal sizes for certain companies.
All right, great, thanks. And for our last question this panel, so Jody, I know we've seen some M&A in your sector, right? We've seen some hotel M&A, we've seen some theme park M&A. Do you expect those trends to continue? Any more big deals, or what else could the companies be doing with their cash?
Sure. So that's a very big question, Steve. I think the companies are going to be doing a lot of things with their cash. For some of the companies, they're back to pre-pandemic levels in terms of leverage, in terms of credit quality. And so a lot of them are giving back to shareholders. But there are companies that are either choosing organic growth or strategic growth. The ones that are choosing organic growth are someone like MGM, when they're looking internationally in terms of expanding, Win with their Abu Dhabi, their UAE expansion, and then MGM with Japan. They're also all vying for the New York downstate license. There's 3 of them. We'll hear at the end of the year which gets them. So stay tuned for that. But I think in terms of M&A, there are a few key M&A deals that have happened. Some of them have been of the tuck-in size, as just Julie talked about. Marriott did one, but Hyatt just did their second, almost, I would say, transformational deal. They're buying Playa, which is similar in terms of size, scale, and way that they're financing as what they did with Apple Leisure in 2021. And what's interesting is they did get put on negative outlook by S&P, but they also proved that they were able to meet their targets in terms of divestitures, in terms of repaying debt once the deal actually closed. So we're interested to see if that's going to happen. We do put some level of credibility towards management when that comes, but it is interesting to see if they're able to meet these targets, particularly given the environment's a little bit different now than it was. Now, there are other companies that are looking at more creative situations. United Parks, which is formerly SeaWorld, has hinted at doing something with their unused properties. And I think we'll also see as Six Flags consolidates a little bit more from the Six Flags Cedar Fair merger of last year, I think we'll see how they're going to look at their assets and all their properties and maybe also get a little bit creative there. I think the one area where we're less optimistic and we've sort of neglected talking about is the rental car space, where naturally things are a little bit rough, and I'm not quite sure what we're going to see there from any sort of standpoint other than maybe creative financing. Restaurants also are going to have a lot of tuck-ins. I forgot to mention them.
All right, great, thanks. I know you have some great work on the terminals, both Hertz and Avis. So with any of the panel guests, you want to see any of the work, obviously it's all available on the terminal. Have any questions for them, please definitely reach out. And if you like what they heard and you want to hear more from their BI colleagues and from a number of high profile outside guests, please join the Bloomberg Intelligence team for their State of the Consumer Conference in New York City on May 7th. And with that, I'm going to pass it over to our private credit markets panel with Nick Beckwith and Mike Holland. Here you go, Nick.
Great. Thank you, Steve. My name is Nick Beckwith. I'm a senior associate here on the BI credit team. I'm joined today by my colleague, senior analyst Mike Holland. Mike, if you want to say hi.
Hey, everybody. I am Mike Holland, credit analyst covering healthcare. It's my pleasure to join you here, Nick.
Great. And also sitting, representing us today is David Havens, not able to make the call. He covers the large alternative asset managers as well as some of the large cap BDCs.
So, Nick, maybe some color on the BDC space. We've seen a lot of headlines the past couple of months and year probably on the golden age of private credit. It seems like the trends is still toward more growth. But I wonder, over the years, it often seems that, the hottest area of finance may, blow up. We saw that with CDS in the years past and market value CDOs and other, new financing structures. BDCs have, seen some significant investment growth in 2024, upwards of 300 billion in 2024. It's about 35% growth. Is private credit overheating in your view?
Yeah, I mean, that's a good question. I guess it really depends on how you look at it. So the growth has been tremendous, like you mentioned, 35% in the past year, led by BCRED, added on about $18 billion in investments. I mean, you and I were talking about this earlier, the ROE and the ROA for some of these BDCs has declined over the past couple of years. But when you look at some of the asset quality stuff, asset quality has been relatively strong. Non-accruals have been low ever since 2022 when the rate hike cycle started, and still humming along below 2%. Payment in kind or PIK has increased, but not necessarily dramatically. And part of that could just be in the way that some of these deals are structured, where they'll do like a mezzanine or preferred, and they'll start the loan out paying PIK rather than going to PIK as a result of some asset quality issues. So I guess it really depends. I think the issue would be a sudden economic shock that would really hurt some of these BDC borrowers that are levered 6 to 7 times. But the BDCs themselves are actually pretty strong. They have about $2 in investments for every $1 of equity. So I think the most damage you would see would be at the borrowers. And then it really just is a matter of magnitude for how that reflects back onto the BDCs.
That makes sense. You mentioned the ROE and the ROA. So your view on sustainability of that growth trend to, from 35% in 2024, and you said, other than sort of a market event, like, are there any other catalysts that might reverse this growth? I mean, are we getting to a point of saturation here?
Yeah, I don't think it's too out of consensus to say that 35% growth is probably not a sustainable number. But I do think you're seeing private assets doubling in the next 4 to 5 years is relatively realistic based on the momentum we've been seeing. As far as things that could slow it down, with the new people that we have in Washington, you may see some deregulation of U.S. banks that may push them back into some private lending to some of these middle market borrowers. You may actually see some tighter regulation in the EU, so that could slow some activity over there as well. And we had talked about this in the M&A panel as well. There's supposed to be a big wave of M&A in 2025, and we've seen some deals, but that big wave is still missing. So it really depends if we'll see that later this year or not. But I do think doubling in 4 to 5 years is pretty realistic.
Well, that's pretty substantial. Where are the raters these days on BDCs? And do you think the spreads where they are today reflect that risk?
Yeah, so that's a good question. I think for the most part, raters and ratings have been trending upwards. Now, again, that's not like a monolith. We've seen some BDCs have some negative rating actions. We've seen FSK get a negative outlook. Prospect was one that just got downgraded to junk. But for those guys, there's also, more than getting upgraded to BBB flat with like Sixth Street, Golub, Ares, some Blackstone ones. So for the most part, the rating trend has been positive, although there have been some negative ratings actions. As far as sort of the capping out, I think most likely you could see some of these guys peak out at maybe high BBB. And I think that is probably really only reserved for some of the guys that have ties to these alternative asset managers like the Blackstones and the Ares, just because they share strategic and other resources. So I think that's probably the cap, and I think it's been a positive momentum so far, but again, some have come down. As far as spreads go, for the most part, these guys typically trade somewhere between BBBs and BBs. I think the path of least resistance is probably spreads nudging tighter slowly over time. Not anything that they would converge with BBB financials, but sort of tightening bit by bit over time. The one caveat to that I would say is this is a very high beta sector. So if there was some sort of market event or economic shock, this sector in particular, I think would widen out more than others.
Interesting.
Yeah.
I get a lot of questions on healthcare and, sort of where do we think new deals are coming? How do they come? Do they come with private credit? Do they, are there's liquidity issues going to be solved with maybe specialty lending, specialty finance? And we see some companies utilizing that have big bond complexes. I mean, Bausch Health is in the news today and yesterday. They're going to be doing a new bond deal. They have a facility that was a specialty lending facility from KKR, right? An AR facility. So some of the big public issuers are utilizing some of this private credit, which I think is pretty interesting from my perspective. What's also interesting too is just the total quantum of loans and direct lending as it relates to bonds, right? If you look at healthcare before the Bausch deal today, high yield healthcare had 1.8 billion in total issuance. Versus 32 billion of loan issuance. Most of the loan issuance is probably refinancing related, but it's just 15, 16 times the market. Direct lending's probably in between there somewhere. We don't have exact numbers, but Bloomberg does track some deals on the new side, on the direct lending side, which is useful. But it's just interesting to me to see the dearth of bond issuance, unless it's maybe a little higher rated in that double B sort of triple B space, but definitely something to follow.
Yeah, absolutely. All right, I think that about wraps it up for us. I just want to say thank you all for participating. If you guys have any questions for me, Mike, or any of the other BI analysts, feel free to circle back to us, and we will get back to you. And thank you for joining. Take care.